A combination of tax implications could potentially cost a senior property owner $75,000 upon selling a residence they have maintained for many decades. Not due to fraudulent activity, not from concealing information, but from a single, well-intentioned family choice most individuals have never learned about. I am aware of a woman from Ohio who discovered this situation unexpectedly. She maintained ownership of her residence for 34 years. She completed the sale last year, anticipating zero tax liability. She had resided there throughout her entire adult existence, brought up her children there, completed payments years prior, a straightforward transaction, a new beginning. She became liable for $2,400. And the choice that triggered it occurred at her kitchen table during a Tuesday afternoon, while she believed she was acting responsibly, believing she was safeguarding her family. It required less than 10 minutes of her time. If you have reached age 60 and you maintain home ownership, April 15th represents the deadline that establishes whether you can address this discreetly or manage it through difficult means. And I express that exactly as seriously as it appears. I am going to explain exactly what she did and why it holds significance for you at this moment. But prior to getting into it, a brief note. Everything I discussed today relies on existing IRS regulations and federal tax legislation, including the comprehensive tax reform measure enacted into law during summer 2025. Nothing in this presentation substitutes for guidance from a licensed tax practitioner. Utilize it as a foundation, not a final determination. Here is what this presentation addresses. 4 pitfalls, 4 completely normal homeowner choices that are silently generating IRS complications for seniors at this time. Then 3 opportunities that could genuinely return money to your account on your 2025 filing that most individuals over 60 have never discovered. Then a 7-step action plan, including a complimentary resource on the IRS's official website that reveals exactly what data they currently possess on your property. Most individuals only discover the pitfalls. Very few discover the money they are abandoning on the table. By the conclusion of this presentation, you will understand both. Do not depart early. The 4 pitfalls create one word, home. H represents home equity errors. O represents ownership and deed modifications. M represents move-out timing preceding a sale. E represents extra income from the residence. Before we proceed further, if this proves helpful today, please press the like button and distribute this with anyone in your life who has reached 60 and maintains home ownership. That single share could preserve someone thousands of dollars. The individuals who require this most are typically the final ones to locate it. Now let me complete her story. Her name is Margaret. She represents a fictional composite created from genuine situations tax practitioners encounter regularly. Every individual I reference in this presentation is identical. Real outcomes, composite personalities. Margaret's husband died several years ago. Her daughter Sarah assumed responsibility after that. Groceries, maintenance, medical appointments, everything. One afternoon, Margaret's neighbor referenced that including Sarah on the deed would simplify things later, prevent probate, maintain the house within the family. It appeared like practical wisdom, so Margaret completed it. County Recorder's Office, basic form, no lawyer, no tax practitioner, no reason to reconsider. Here's what nobody informed Margaret. When you transfer partial ownership of your residence to another individual, even your biological child, the IRS can categorize that as a taxable gift. Depending on the value transferred, that may activate a reporting obligation on Form 709. And when the residence is ultimately sold, the individual you included on the deed may not qualify for the identical tax exclusion you do, because they never resided there as their primary residence. Margaret discovered 2 years afterward, when her tax preparer examined her return and stated 4 words she was not prepared to receive. We need to talk. Every dollar of that liability was avoidable. The IRS does not consider why you completed something. It only examines what you completed and whether it was documented appropriately. Good intentions do not appear anywhere on a tax return. So let's examine the H home equity errors. Stay with me, because this is where most people's attention fades. And that fading attention is exactly what costs them money. Most homeowners believe that if funds originated from their house, it must be linked to the house for tax purposes. That assumption is incorrect. Full stop. A senior borrows $40,000 or $50,000 against their residence through a home equity line of credit. They utilize it to assist a grandchild with college, address a medical emergency, or eliminate debt. And because it originated from the house, they assume the interest is deductible. It is not unless the funds were utilized to purchase, construct, or substantially improve the residence securing the loan. That is the regulation under the Tax Cuts and Jobs Act of 2017. If the funds went anywhere else, that interest is personal interest, not deductible, and claiming it incorrectly creates a discrepancy that the IRS's automated systems are increasingly effective at identifying. Think back right now. Did you obtain a home equity loan or establish a home equity line of credit in the past 3 years? Where did that money genuinely go? Into the house or somewhere else? If it went somewhere else, you require a conversation with a CPA or enrolled agent before April 15th, because if that interest was managed incorrectly, there are steps available right now that become much harder after the deadline elapses. And the O pitfall is the one that generates the most disagreements when I explain it, because people hear it and immediately state that cannot be accurate. That is just a family choice. I hear that every single time, and every time I state the same thing back. That is exactly why it is so hazardous. A senior includes an adult child on the deed for estate planning, probate prevention, or just because that child has been assisting, and it feels appropriate. What feels like a family choice is also a tax choice, and those two things do not always desire the same outcome. Think about the previous 5 years right now. Has anyone's name been included on your property? A child, a grandchild, anyone? If yes, and no gift tax return was submitted that year, keep listening, because this next section is specifically for you. When you include someone on your deed without them providing fair market value, the IRS can classify that as a taxable gift. When the value transferred surpasses the annual exclusion limit, a Form 709 gift tax return is generally required depending on the structure of the transfer and your specific situation. If that was never submitted, that is a documentation discrepancy sitting quietly in your history. And when you ultimately sell, the individual you included on the deed may not qualify for the primary residence exclusion, the regulation that permits most homeowners exclude up to $250,000 in capital gains or $500,000 for married couples because they never resided there. Their portion of the gain may be fully taxable. A transaction that should have been tax-free becomes partially taxable over a deed modification that required 10 minutes. I've conversed with seniors who discovered this at the closing table, not before the sale, not during the listing, at the closing table, papers already before them. That is when they heard it. There is also the basis concern. If you transferred the residence entirely as a gift rather than leaving it as an inheritance, the recipient receives your original purchase price as their cost basis, not today's value. If you paid $80,000 and the residence is valued $380,000 today, they could owe capital gains tax on $300,000 when they sell. Had they inherited it instead, the basis would reset to current market value, and that gain would largely disappear for tax purposes. One path cost the family nothing. The other cost them tens of thousands. The only difference is the timing of the transfer. Now, that specific reason, April 15th, matters more than people realize. The IRS has an automated system called the Automated Underreporter Program. It cross-references your tax return against third-party data. Mortgage servicers, rental platforms, issuing 1090 non-cacao forms, and property-related records. The discrepancy between what you reported and what the IRS can observe has been decreasing for years. Tax practitioners are observing more automated notices and more matching discrepancies than at any point in recent memory. After April 15th, if something hasn't been addressed, interest starts accruing automatically. Penalties accumulate. And the first-time penalty abatement program, a real documented IRS policy that permits taxpayers with a clean compliance history to request significant reduction or elimination of certain penalties, becomes harder to utilize once assessments are finalized. The earlier you act, the more options you possess. Now, the move-out timing. This is the one that affects seniors hardest, and it is the most misunderstood regulation in residential tax law. Under IRS Section 121, to exclude up to $250,000 in capital gains from your residence sale, $500,000 if you're married filing jointly, you must have resided in the residence as your primary residence for at least 2 of the 5 years immediately before the sale. That is the 2 out of 5 regulation. Here is where it quietly destroys people. Let me demonstrate exactly how this occurs. And as I walk through this example, I want you to envision your own residence, your own address, and think about where you have been residing for the past 3 to 5 years. You relocate with your adult kids because of a health concern or into a smaller place while your house sits on the market, or you start renting it out while you wait to sell. All of these are understandable choices. All of them affect your residency calculation. Say you relocated with your daughter in January 2021, or you maintained the house, attempted to sell, couldn't obtain the price, rented it for a year, and finally sold in March 2026. You relocated January 2021. Sale concluded March 2026. That is more than 5 years since you last resided there. Under the 2 out of 5 regulation, you may not qualify for the exclusion at all, because both qualifying years fall outside the 5-year look-back window. If the house gained $200,000, you could owe capital gains tax on the full amount. For most homeowners in this income range, that is roughly $30,000, not because you completed anything wrong, because retirement circumstances and a tax timing regulation collided in a way nobody warned you about. There are partial exclusion provisions under Section 121C for health-related moves. They are genuine, but they require documentation and do not apply automatically. And here's something I want you to remember, because Dorothy's story in a few minutes demonstrates exactly what happens when this pitfall combines with the next one. If you have relocated from a residence you still maintain and plan to sell, count the months this week. The window to address this exists right now. And now the extra income from the residence. This is the one people dismiss first because the amounts feel small. That dismissal is exactly what makes it expensive. A senior rents out a spare room, maybe through a short-term rental platform, maybe just to a college student, maybe a family member provides something modest to stay in the basement apartment. It addresses the utilities. It feels like a practical arrangement. But the moment your residence generates rental income, any amount, any arrangement, the IRS treats that portion differently. 3 things change. First, that income must be reported on Schedule E. Informal arrangements are not exempt. No formal lease does not mean nothing to report. Second, a portion of your residence expenses become potentially deductible against that rental income, but without documentation, you either face audit exposure or you overpay. Third, if you later sell the house, the rental portion may not qualify for the primary residence exclusion. The gain gets allocated between residential and rental portions. The rental portion can be taxed as a capital gain, and depreciation recapture under Section 1250, taxed at up to 25%, can apply to the rental portion even if you never claimed depreciation in the first place. That spare room you rented for $600 a month for 2 years can affect the tax treatment of your entire residence sale. Not just that room, the whole transaction. Now Dorothy? Dorothy is 68, Tennessee, resided in her residence for 27 years. In 2022, a health scare pushed her to relocate with her son, Michael, temporarily. She told herself to address expenses while she waited to sell. She rented the house to a young couple, $5,100 a month. She didn't report it the first year because her accountant had just retired, and the software she utilized didn't ask the right questions. The following year, Michael included his name on the deed just in case Dorothy's health got worse. No gift tax return submitted. Early 2025, Dorothy sells. 27 years of ownership. She walked into that closing anticipating a clean, essentially tax-free sale. The IRS determined she had relocated more than 2 years before the sale. The rental period had changed part of the residence's classification. The deed modification created a gift reporting discrepancy. The unreported rental income was a separate liability underneath all of that. Dorothy owed $23,400 across 3 separate concerns, none of which she knew existed when she made the choices that caused them. She wasn't negligent. She wasn't hiding anything. She was a 68-year-old woman, managing a health crisis, a housing transition, and a family situation simultaneously, without anyone informing her what she needed to know. Dorothy did not fail the system. The system failed Dorothy. But the system does not adjust itself based on that fact. That is the whole reason this presentation exists. I want you to sit with that for just a second, because what comes next is genuinely different from everything we have addressed so far. And most people watching this are going to wish they had known it sooner. Now the other side of this, because everything so far has been about problems. The next few minutes are about money you may be abandoning on the table right now. Real money verified by the IRS available on your 2025 return. The first is brand new, and most preparers are not identifying it automatically. It is called the senior bonus deduction, and it is part of the comprehensive tax reform measure enacted during summer 2025. If you are 65 or older, you can now claim an additional $6,000 deduction on top of whatever you already deduct. Whether you itemize or take the standard deduction, it accumulates on top of both. Married with both spouses 65 or older, that is $12,000 total. Available for tax years 2025 through 2028, phases out starting at $75,000 modified adjusted gross income for single filers and $150,000 for joint filers. For many seniors in the zone where 50 to 85% of Social Security is taxable, this deduction reduces taxable income down enough to reduce that exposure. It will not eliminate Social Security taxation entirely, but it can meaningfully reduce it. For many seniors, that is $1,000 to $2,500 in real savings. This provision was included in an extensive bill. Some tax software has not been updated. Some preparers have not caught up. Ask your preparer directly, did you apply the senior bonus deduction from the recent tax reform? If they look confused, find someone who does not. The second is the state and local tax deduction increase. From 2017 through 2024, the state and local tax deduction was capped at $10,000. For homeowners in New Jersey, New York, California, Connecticut, and Illinois, where property taxes alone often exceed $10,000, that cap was painful. You paid the taxes. You received no deduction for the excess. As of 2025, that cap is now $40,000. For 2026, it is $44,000, increasing 1% per year through 2029. The phase-out starts at $500,000 in modified adjusted gross income, well above where most retired homeowners sit. Here is the problem. When the cap dropped to $10,000 in 2017, millions of homeowners switched to the standard deduction and never looked back. 8 years on autopilot. The cap has quadrupled. Their habits have not changed. If your property taxes plus state income taxes exceed $10,000, run the numbers again. Add your total state and local taxes to your mortgage interest and charitable contributions. If that total exceeds the standard deduction for your filing status, you should be itemizing. If you already submitted using the standard deduction when itemizing would have saved you more, you can amend within 3 years. Do not leave that money sitting there. The third is the energy credit. If you installed solar panels, a heat pump, battery storage, or other qualifying energy improvements in 2025, the 30% federal residential clean energy credit is still on your return for that installation. The recent tax reform eliminated this credit, effective December 31, 2025. Systems installed and operational by that date still qualify. Systems installed January 1, 2026, or later do not. The IRS has confirmed the cutoff is based on when installation is completed and the system is placed in service, not when you signed the contract or paid the deposit. If you have a 2025 installation and have not yet submitted, make sure that 30% credit is claimed. On a $30,000 system, that is $9,000 you do not want to leave behind. For future upgrades in 2026 or beyond, that federal credit is gone. Some states still have their own programs, but the 30% federal credit that millions counted on is no longer available for new installations. Now, this last one is different. It is not about your tax return at all. It is not about something you completed wrong. It is about money leaving your bank account every single year right now that you may be able to stop today with a 20-minute phone call. And there is one more thing most seniors have never been informed about. This one has nothing to do with the IRS. It is a state and local property tax benefit, and it varies by where you reside. But for many people watching this, it is worth more over time than anything else in this presentation. Almost every state in America offers a property tax homestead exemption for seniors. These are not small discounts. In Texas, the over 65 homestead exemption alone can reduce your residence's taxable value by $60,000 or more on top of the standard homestead exemption, saving some homeowners $4,000 to $6,000 every single year. Florida freezes your property tax assessment at the value it was when you first qualified, meaning even if your neighborhood doubles in value, your property taxes do not increase. Georgia offers full exemptions from school taxes for qualifying seniors. New York, Pennsylvania, Ohio, Illinois, almost every state has a version of this. Here's why this should make you genuinely aware. These exemptions are not automatic. Nobody sends you a letter when you turn 65 stating your taxes just decreased. You have to apply. You have to go to your county assessor's office or appraisal district, complete a form, show proof of age and residency. If you have been 65 or older for years and never applied, you have been overpaying. Some states allow retroactive applications going back 1 or 2 years, meaning you could receive a refund on taxes already paid. Call your county appraisal district this week. Ask what senior property tax exemptions are available. Bring your identification and your deed or a recent tax statement. It takes about 20 minutes. And for many people watching this presentation right now, that call will save more money over the next 10 years than anything else addressed here today. Now, before the checklist, 60 seconds on something that has nothing to do with taxes. It has to do with protecting yourself from people who will utilize everything you just heard against you. Every tax season, scammers target senior homeowners aggressively. Phone calls, emails, people pretending to be IRS agents stating you owe money right now and will be arrested if you do not pay by wire transfer or gift card. The real IRS does not call you demanding immediate payment. The real IRS does not accept gift cards or wire transfers. The real IRS does not threaten arrest over the phone. The real IRS communicates through official postal mail with a notice number in the upper right corner of every letter. If anyone contacts you, claiming to be the IRS and creates urgency around immediate payment, hang up. Delete it. Report it to the IRS phishing hotline at phishing@irs.gov. The concerns in this presentation are real. The people trying to exploit your fear about those concerns are also real. Know the difference. Now, the action checklist, 7 steps this week. Step 1, pull your last 3 years of tax returns. Look at Schedule A for mortgage interest. Look for Schedule E, rental income lives there. Look for any 1099 connected to the property. Anything missing or unexpected, write it down. Step 2, find your deed. County Recorder's Office can provide a copy online for a small fee. Check every name listed. If a name was included in the last 5 years and no Form 709 was submitted, that needs professional review before April 15th. Step 3, map your residency timeline. If you have relocated from a residence you still maintain, calculate how many months since you last resided there as your primary residence. If that number is at or past 24 months and you have not sold, obtain professional review before the sale concludes. Step 4, check your IRS account transcript at irs.gov. Create a free account, 15 minutes. You will observe every notice on file for your account and every piece of third-party data the IRS has matched to your Social Security number, including 1099-K data from rental platforms. If the IRS has information about your property that does not match your return, you will observe it there. Knowledge is the only thing that gives you options. Step 5, track your home equity records. Find documents for any home equity line of credit or home equity loan. Write down exactly what those funds were utilized for. If they went into the house, you likely have a clean paper trail. If they went somewhere else, your return may need review. Step 6, list every rental arrangement the property has had, any amount, any arrangement, dates, and amounts. A tax practitioner can inform you what was managed correctly and what needs to be addressed. Step 7, contact a CPA or enrolled agent this week if you have any uncertainty after steps 1 through 6. The National Association of Enrolled Agents has a free directory at naea.org. Search by location and specialty. When you call, ask specifically whether they have experience with IRS penalty abatement for real estate concerns. That one question informs you immediately if they are the right person. Dorothy completed none of these 7 things, not because she was careless, because nobody provided her this list before she needed it. You have it right now. Use it. The cost of a professional review is almost always smaller than the cost of the problem it was supposed to prevent. Let's bring it all together one final time. The 4 home pitfalls. H. Home equity. Money from your house is not automatically deductible under IRS regulations. O. Ownership changes, including someone on your deed, is a tax event, whether you intended it to be or not. Move out timing. The 2 out of 5 regulation does not pause for retirement or health transitions. E. Extra income. Rental income from your residence changes its tax classification, and that change follows the property all the way to the sale. The 4 things working in your favor right now: the $6,000 senior bonus deduction available on your 2020 return, the state and local tax cap at $40,000. If you are in a high tax state and still on standard deduction autopilot, run the numbers again. The 30% energy credit for 2025 installations that have not yet been submitted, and the senior property tax homestead exemption sitting unclaimed at your county appraisal district that could save you thousands every year. If even one of the 4 pitfalls sounds familiar, do not file this away as something to consider later. That is exactly how Margaret ended up hearing those 4 words. That is exactly how Dorothy ended up owing $2,400 on a sale she expected to be clean. Start with step 1 tonight. The deadline is April 15th. By then, what could have been a quiet fix becomes a scramble, and scrambles are expensive. If this presentation helped you, press the like button right now. Subscribe if you are not already here. Share it with anyone over 60 who maintains a residence, and drop a comment below. Which one of these did you not know about before watching? That question genuinely helps me decide what to address next, and your answer might be the topic of the next presentation. In the next presentation, I'm going to walk through Form 709, the gift tax return that most seniors never submitted when they changed their deed, and show you exactly how to address that discrepancy before it becomes a formal IRS notice. If Margaret's situation sounded familiar when I told her story at the beginning of this presentation, that next presentation is specifically for you. It is already on your screen. Watch it now because this is exactly the kind of topic where waiting costs you more than acting.